Welcome to the latest Quest for Twice. This is a earnings season, so it's very exciting for me as a value investor because this is when the companies I'm interested in or have invested in will report their financial results, and only through the financial results I will have a strong idea on if my initial investment thesis stays valid. So let's look at what happened in the recent month about the midstream companies. As a reminder, I invested in Energy Transfer, which is a pipeline company considered as a midstream in the energy sector. On this graph shows the recent month stock performance of Energy Transfer versus Kinder Morgan. The Kinder Morgan is the orange line. The black bars are Energy Transfer. So on October 21st, Kinder Morgan announced the Q3 financial results. Its dividend remained unchanged. You can see on the following day, both stock went up. Energy Transfer went up significantly more. Energy Transfer also announced the new CEO will be in place on January 1st of next year. It was announced on October the 8th, and Energy Transfer had a big stock price increase on that day. And on October 26th, Energy Transfer announced the future dividend cut by 50%. And on the following day, on October 27th, Energy Transfer's stock price suffered greatly as a result of that announcement. So let me first refresh about the risk analysis I did before I purchased the Energy Transfer's stocks at the end of August. So in the near term, the risk was the 2020 cash flow is insufficient to cover its cash need, including capex and dividend. So specifically, there were several scenarios. For example, if the financial system crashes and the Energy Transfer loses access to additional credit, it cannot borrow, then it has to cut its cash outlay. Another one is if Energy Transfer suffers any major spill or safety accidents. Third one is if a large number of its customers go bankrupt and stop paying for their shipment commitment. And I also mentioned there that if Energy Transfer cuts its dividend distribution by $1.3 billion each year, its forward yield would drop to 12% from 19% at that time. I also reviewed the risks related to the so-called blue wave, i.e. the Democrats will control both White House and Congress through the general election in next week. However, I did not believe that's a major risk to Energy Transfer because it, as a corporation, pays very little income tax, and also as the Democratic Party strive to move towards less emission of CO2, they probably will ban flare or venting of associated gas, which is a low-hanging fruit and which is good for the business of midstream companies. Another risk is that the court may force Dakota Access Pipeline to shut down, and then Energy Transfer will lose the associated revenue and income. In the long term, the risk is that the society is moving towards renewable energy and has less demand for natural gas. So let's look at the financial reports coming out of Kinder Morgan's Q3 results, uh, and with those risks identified in August in mind. So and let's look at the EBITDA reported by KMI. And the pie chart shows the components of its EBITDA from its major segments. And the first major takeaway is that it's a natural gas pipeline segment is the most important contributor to its income. That it contributes 62% of its EBITDA. Its terminal business and the liquid line includes crude oil and refined products. Each contributes about 15%, and the rest contribution comes from its CO2 shipment business for about 10% contribution. So an important consideration is to look at the volume change, especially related to natural gas, because that's the most important contributor to its earning. So year on year in Q3, its natural gas volume shipped is 3% less compared to 1 year ago. That's a very small change considering the general state of the economy. Its liquid line, including crude oil and refined products, had a much more significant drop by 17%. I did not list the terminal and CO2 because they are less important contribution. And in terms of earning change from 1 year ago, the natural gas pipeline had only 1% drop if it's in its EBITDA. And liquid line had a 20% drop, and that's consistent with its volume reduction. Terminal EBITDA reduced by 17%, so that's similar as a liquid line. And the CO2 business had an earning increase by about 3%. Overall, its earning in Q3 dropped by about 6% compared to 1 year ago. And why is that? That's because, again, the natural gas segment is the most important contributor to its earning, and it only had a 3% volume reduction in compared to 1 year ago. So that's why its a Q3 earning is holding up fairly well compared to 1 year ago. Kinder Morgan also announced in August 2020, it issued two bonds, one for the amount of $750 million at a 2% interest rate for the 11 years. Another bond was for about $500 million at the interest rate of 3.25% for 30 years. So both bonds are sold at a very low interest rate. It indicates that the credit market has full confidence in Kinder Morgan's ability to maintain its credit rating and also to pay its debt back in the future. So in that context, and also in the revenue and the volume change information I reviewed on the last slide, we can review the risks. So obviously the financial system is continuing to provide credit to Kinder Morgan. So it's unlikely that the Energy Transfer will lose access to borrow additionally. So far, there is no news about any major safety or spill incidents by Energy Transfer. Based on Kinder Morgan's results, It seems that there are no major default or bankruptcy uh, leading to shipment volume reduction by Kinder Morgan. So by extension, I would say that same picture applies to Energy Transfer. The last one, so given that all the three green lights for the first three, it's a little bit surprising to see that the Energy Transfer decided to cut its distribution by half. That's about $1.65 billion. It's a little higher than uh, what I calculated to avoid the borrowing in 2020. So I gave it a red light. And about the general election, of course, it's still ongoing. It won't. The election is next week, so we will see what happens. And Dakota Access Pipeline, the court won't rule until Q1 next year, so it's still outstanding. In the long term, about the energy transfer and the midstream asset, I dive into the conference call by Kinder Morgan, and the Kinder Morgan CEO mentioned that one use of its gas pipeline is to ship hydrogen. Of course, it's difficult to ship hydrogen because of there is a phenomenon called hydrogen embrittlement, which means that hydrogen may make a steel brittle and fracture. Then there will be major release. However, according to Kinder Morgan, that hydrogen can be blended with natural gas to the ratio about 6 to 16%. So as a result, that hydrogen and natural gas can be shipped together, and of course, I believe it also can be burned together. So as a result, it will reduce the CO2 emission from burning pure 100% natural gas. So that will, in essence, make natural gas blended product less polluting. Also, based on the information I reviewed last week, even if the demand for crude oil and natural gas plateau in the next 10 to 20 years, it's not going to dramatically decline in its volume. As a result, all that production has to be shipped from the producing regions to the customers, and the midstream company doesn't really and so that the midstream company will still have plenty of business, even if in the future the renewable energy will take in greater and greater share of the total energy mix. So let's take a look at some key valuation and the financial metrics for Kinder Morgan of Energy Transfer in Q3 versus Q2. So both companies have suffered stock price decline when I prepared the Q2 table. As a result, its EV over EBITDA ratio actually become for Kinder Morgan become a little less, and that essentially remain unchanged, and the market cap both decline. And for this year's cash flow, Kinder Morgan's indicated last week that it essentially stayed the same at $4.5 billion, and its capital plan remain unchanged. So as a result, for this year, the its dividend commitment is 2.4 billion and plus 1.7 billion of capital. That's 4.1 billion. That's less than its cash flow. So there will be additional cash left after paying capital and dividend. For Energy Transfer, its Q3 earning results will come out next week. So it'll be interesting to see what will be its debt level and latest update to its cash flow in 2020 and this year and the next 2 years capital plan. We know one thing for sure is it has reduced its dividend to 1.65 billion, and because of its recent stock price decline, so its yield now is about 10%. With the forward dividend commitment of 1.65 billion plus the initial capital plan of 3.4, then it's adds together will becomes about 5 billion. It's less than its cash flow forecasted in the Q2 earning results of 5.4. Then it will become cash flow positive. So here are the key questions for next week. Really, it can be summarized as one word: why? Why did the Energy Transfer cut its dividend? Was it because of it has a less distributable cash flow forecasted compared to Q2? If not, then it cut its dividend really is a decision to repurpose its cash flow, and then that's not really as bad news as a reduced forecast of cash flow. So how will Energy Transfer use the excessive free cash flow because of less commitment to pay future dividend? Will it use it to pay debt, reduce its debt level, or buying back shares, or invest in additional pipeline projects? In my opinion, paying down debt or buying back shares are both a good use of cash compared to paying a dividend to shareholders. And on the previous slide, we have seen that Energy Transfer has a much higher debt level compared to Kinder Morgan. So I suspect Energy Transfer gave a high priority to pay down its debt over buying back shares or paying dividend. If the additional free cash flow will be used to build additional facilities, pipelines, or terminals, then to me that's not a good use of its capital, because one is the current state of the economy, and the oil and gas demand has not fully recovered. Two is just the uncertainty ahead. So, in my opinion, that will likely be distracting shareholder value. The third question is, hopefully we'll get some information next week, is that after the cut, is the dividend sustainable even if the Dakota Access Pipeline is forced to shut down, or if shutdown of that pipeline will introduce additional dividend cut? So those are the key questions to be answered hopefully through the earning results to be announced by Energy Transfer next week. So until then, happy investing.